For more on today's market rally and whether it can continue, Natixis' Jack Janasiewicz joins us now. He is the firm's lead portfolio strategist. JJ, great to see you.
Yeah, thanks for having me back.
Obviously, it's a very volatile time, but insofar as, it sounds like we've already seen the worst. Maybe I'm being Pollyannish about this. Maybe we've seen the worst the tariffs can be if they're already talking back and trying to relieve the tension between it and China, which is probably the most focused on, trade relationship here.
Yeah, and I think you could look back at that April 2nd announcement, Liberation Day, and potentially call that peak tariff, because if you think about what was really enacted, it certainly came in much more draconian than market expectations. And between then and basically the low that we saw on the 8th, we had a pretty substantial drop in the equity prices. And, when we look at past drawdowns that are associated with at least mild recessions, you get almost a 20% correction. We almost got there. So from a pricing in of a recession prospects on the back of draconian measures there, maybe that 5,000 level on the S&P really did define that bottom of the range in here. So it gives us a little bit of prospects in terms of what that downside risk might look like.
JJ, how focused on the Treasury market are you? Yields in the 10-year today traded as low as 4.25. They almost got back to 4.40. We know we're working off a level of 4.50 from just a couple weeks ago when things were going haywire. Is that an important input to you as you're thinking about where the stock market can kind of find its level? It sounds like you think 5,000 might be a low, at least intermediate term.
Sure, and the Treasury market, I think, is going to send some interesting signals. But what I think is a little bit of a cross current here that's making this a little bit hard to digest is simply the potential for deleveraging and degrossing that we've been seeing. And so I think some of the move that we've seen in the Treasury market is a function of, increased volatility. As a result, you're getting the VAR limits blown out. You're getting a tap on the shoulder from your risk manager saying, you have to delever, degross, and as a result, you're selling treasuries. And I think that might be putting some upward pressure on the market. And so as a result, it's tough to sort of fish through what's technically driven here versus fundamentally driven with regard to what's going on in the Treasury market. So that complicates things a little bit.
Right. You mentioned the 20% or the almost 20% drawdown that we've already seen, Jack. But, in typical recession, the PEs, the forward PEs are much lower than where we are now. So how do you sort of reconcile that drop saying in past, drawdowns, pricing recession is 20% versus the turns that we would have to take lower on the PE side in order to match a recessionary environment?
Yeah, and typically in these recessions, you get a PE multiple that compresses somewhere between 20 and 30%. But what happens is then we finally start to see that E in the PE starting to adjust lower, right? Prices with regard to the stock market, we already are pricing in that discount where analysts are a little bit slow to adjust. And so what happens roughly about halfway through that earnings downgrade, you actually start to see PEs expand. That's because you're finally seeing the E catch down, so to speak. So, you're pretty close to some of that revaluing with regard to that multiple, maybe a little bit more to go. But again, when you put all these things together, it's an art more than a science. And we're pricing in quite a bit of potential slowing here when you get down around 5,000 on the S&P.